What's up, friends, fellow investors, and fellow entrepreneurs? It's your boy, Dave P., my main man, RJ Pepino. We are The Cream. If you're new to The Cream, new to the channel, The Cream is for cash flow, real estate, and money. We are full-time real estate investors and entrepreneurs. We are all about doing deals and making money, and we are here to support you on your journey in real estate investing as well. RJ, how's the vibe?
The vibe is alive today. Happy Wednesday, everybody.
We are continuing our conversation in talking about buying properties and doing real estate investing in a rising interest rate environment. So if you watched our last video, we were talking about how we need to be more conservative in our buy box when we are in a rising interest rate environment, right? Everything changes. Today we're going to be talking about the BRRRR strategy. And if you're not familiar with what the BRRRR strategy is, this is where we buy, renovate, rent, refinance, and then repeat. We're going to be talking about that third R today. And in a rising interest rate environment, the third R, which is the refinance, is definitely affected. So RJ, what are you seeing right now in this environment, and how is this affecting our business?
Yeah, so we have a lot of refinances happening right now, and we're always anticipating how it's been with local banks and also these nationwide lenders of having a 75% to even 80% loan to value point. And that's kind of how we've been offering on properties that we are going in with the intention of it being a rental. So right now, with one of the recent refinances, that rate has actually gone down in LTV to 70 to 65%. And I mean, it's been at a minimum of 75% for a long time. And this time around, with what's going on, it's dropping. So now we have to adjust our buying criteria, because you got to have better deals, especially if you're anticipating to take some cash off the table on these refinances, which is what we teach and what we like to do.
We like to take cash off the table on a refinance because that is all tax-free operating capital that we put right into the bank. Mm-hmm. And when we're getting a lower LTV from the lender, that means less potential cash out on the refinance. Also, interest rates are changing. That's what we're talking about. How do the interest rates kind of change what we're doing here?
Yeah, so what happens is when you're pulling the cash out, you're taking less cash out, obviously, because now you have to get better deals, and it might not even be a deal at that point because you're trying to satisfy your motivated seller, and sometimes it doesn't pencil out. But then also, your cash flow, your net cash flow changes a little bit too. Would you agree?
100%. Your payments go up. That's what a rising interest rate is going to make your payment go up, and that is the payment you got to pay the bank against your rental property every single month, right? So that dips right into your cash flow, right into your money that you're kind of living off if you're a landlord, right? So with that being said, what RJ was mentioning, we have a big refinance. It's getting ready to close Friday. And we were supposed to take out 75% loan to value. So let's pretend it was $1 million worth of real estate. They would be lending $750,000 or 75%. But since the interest rates are rising, banks are tightening up just a little bit. They don't want to give the 75% loan to value anymore. They dropped us down to 73%. Makes it a little bit more of a conservative loan for the lender. But what it means for us, from our standpoint, is we got a lower loan amount. So we are pulling out less capital at the closing table. And like RJ said as well, the interest rates are going up. So that means our payment, we're locked in this particular loan at 4.5%. It's a little bit rich. Mm-hmm. We're used to getting interest rates lower than that, and we have been getting interest rates lower than that for the last several years, but the interest rates are going up, which means our payment is going up as well. We're still very much in a very positive cash flow experience with these properties, which is good. We're still pulling out money, just not as much money with this particular loan. But in a rising interest rate environment, when your payment is affected and the amount of capital that you're pulling out is affected, make sure you're conservative with your buy box, make sure you're buying really good deals, and make sure you're treating debt like a loaded gun. RJ, him and I were having a conversation earlier today where there's no way you can build a real estate empire, build a real estate portfolio, scale your business without leverage, without debt. That's what makes real estate a great business. You could easily borrow capital and borrow money against the real estate so you could grow a portfolio pretty quickly, right? Now, we need to use debt responsibly. So when interest rates are changing, that's why you got to be conservative with your buy box. Don't buy bad deals. Let's just tell it like it is. If you buy bad deals, you're going to get stuck with properties. If you use bad loans to buy these properties, you're going to get stuck in negative cash flow situations, and then you can get stuck in a situation where maybe you can't resell the property. You end up losing money. We always want to be making money.
Yeah, so I mean, here's an example deal that's going on right now, and how this matters to you is that, you know, we bought this house. We use private lenders to buy houses and apartments, okay? And then, so it's none of our own capital. They're going to fund 100% of the purchase and rehab. This house in particular, which is an Airbnb. So imagine getting an Airbnb with none of your own money. This is an example. We're purchasing it for $320. We have $25K in rehab. It's pretty, you know, light cosmetic rehab. We're going to do another $8K in staging. And staging, and get all the appliances and all this stuff. We're going to be probably into that thing for close to
365-ish.
Yeah, 365, right? And our ARV, we're thinking it's probably going to be around 460. If now, since it's 70%, right? We got a really good deal. We got hooked up. It's not 70 for us, but if it was 65 or 70%, we would actually have to come to cash to the table to get that deal done, because what's 460? What's 70% or 65% of 460? Like what, 330-ish?
I don't know.
330.
Yeah.
We have to.
And we owe 365.
And we owe 365.
Yeah.
So if we were going to refinance and try to, you know, close this thing, obviously we get a better rate, but we're actually coming to the table now. Now, if it was 75 or 80% of 460, we're in good shape, because that loan we're getting is probably in the 360s, 365 or 370. So we would use that loan to pay back our private lender. Okay, thank you. We just, you know, he made a lot of money, he or she. And now we have this asset that we own with the bank's money, and it's still a good deal because you know, our Airbnbs are outperforming our long-term rentals 4x, and so it's a powerful thing to really get a good grasp of. Like when the interest rates are rising, you have to be getting better deals and underwriting them just a little bit more conservatively so that you can protect your buying model, you know, so that you don't have to get caught with your pants down when the tide comes in.
Yeah.
So,
well, and really, in layman's terms, what RJ is saying, and this is something we experience all the time, when we buy properties, we use private lenders, and we want to be all in to the property, meaning purchase and rehab, for lower than we know we can refinance the property out. So let's pretend the property is worth 400. We're all into the property for, let's say, 300, meaning purchase and rehab from a private lender. We borrowed 300,000 for this property that's worth 400,000, right? We want to be able to buy a good enough deal so when we refinance this property, the bank is going to come in with enough money where they can pay off all of the private lenders' funds, so we don't have to bring any money to the table. That's the ideal scenario. So in that example, if the property is worth 400, we borrowed 300 from a private lender to purchase and rehab the property. If the bank is only willing to give us 280,000, right, just as random numbers, we would need to bring that $20,000 to the table to pay off our private lender. So make sure we're buying good deals always, but especially now, because as rates continue to rise, as the banks continue to tighten and lend less, a lower LTV, it's even more important than ever before that we are buying really good deals to prevent us from having that private money stuck in place, or not having the money to bring to the table to close out a BRRRR, right?
Yep. Yep. So that's one example where we're seeing it, and I think also a lot of the flippers that just do that for, you know, they flip. They're going to see a lot of effects in that too, because it's higher payments, higher holding costs, and that would tighten up how they're going to buy. And if they're anticipating 40 a 40K spread, right? A 40K spread is a really good spread for us here in Ohio, but it might mean that, okay, instead of 40K, they're probably looking at 30K. You know, it does affect the flippers too, in a sense.
It affects the flippers, and that's an excellent point, RJ. It affects the flippers simply because when the rates are rising, it makes the buyer pool smaller. So let's pretend you were a fix and flipper, you bought the property, and you're expecting, when you first bought this fix and flip, before you even started swinging the hammers on the thing, when you first closed on it, you were penciling the deal out, anticipating to, let's just say, sell it for $400,000. Well, as the interest rates go up, there's a lot less buyers for $400,000 because the payment would go up on a $400,000 loan. When the rates are super low, there's more buyers for that property because more people could afford it. But as the rates go up, the buyer pool begins to shrink because less and less people can afford that. That affects the fix and flipper because maybe they were penciling this deal and expecting to sell it for $400, but now since there's less buyers, now maybe they got to sell it for $380. It cuts directly into the profit of what you were expecting to sell something for. Maybe you got to be willing to accept less since there's less buyers out there.
Look, guys, we're going to be probably we're going to be doing more of these episodes. If you have any questions about this and how kind of like how we're preparing for this, how we're operating and making our offers, how we're finding private lenders, how we're doing this real estate business every day, just leave a comment when you see this video. We'd appreciate it. And if you could just share it with somebody. You know, Dave and I are wanting to answer a lot of your questions. Sometimes we can't see them. So just tag us here. You're seeing it here on YouTube or wherever other socials. So definitely do that.
It's been a presentation of The Cream. It's your boy RJ and Dave P, and we will see you on the next video.